a new study just dropped, and the numbers are brutal. 80% of viral finance TikToks are misleading. Risk disclosure failures jumped from 30% to 60% in a single year. That means 4 out of 5 money videos in your For You page are either wrong, incomplete, or deliberately leaving out the risks. And millions of people are making real financial decisions based on 60-second videos from people who have never managed real money. Here is what they are getting wrong, and here is what actually works. Okay, so before I start swinging, let me show you the bat. A site called DIY Investor just published their finance TikTok report card for 2025 and 2026. They reviewed dozens of viral investing TikToks, scored them on accuracy, risk disclosure, oversimplification, and educational value. The results? In 2025, 70% of the videos scored a C or below overall. By 2026, that number climbed to 80%. Risk disclosures, meaning the part where the creator is supposed to tell you, hey, you could lose money doing this. Those failures jumped from 30% receiving an F in 2025 to 60% getting an F in 2026. Accuracy? In 2026, accuracy? In 2026, be 100,000, 70% of videos scored a C or D. In 2026, not a single video earned an A for accuracy. Not one. This is not my opinion. This is not my opinion. This is graded. And if your gut has been telling you that something feels off about the financial advice blowing up on your feed, congratulations. Your gut was right. Let's start with the greatest hit of all time, the one you have heard 1,000 times. Just buy the dip, bro. Sounds smart, right? Market goes down, you buy, market comes back up, you profit. Simple, elegant, and dangerously incomplete. Here's the part they never tell you. The Nikkei 225, Japan's main stock index, hit its all-time high on December 29, 1989 at 38,915. It did not reach that level again until February 22, 2024. That is 34 years. If you bought the dip in Japan in 1990, you waited 3.5 decades to break even. The Nasdaq peaked in March 2000 during the dot-com bubble. It crashed 78%. It did not recover to a new all-time high until April 2015. That is 15 years. Buy the dip without understanding valuation, without understanding what you are buying, without understanding why it dipped. That is not a strategy. That is a prayer. Here is what actually works. Dollar cost averaging. You invest a consistent amount at consistent intervals regardless of whether the market is up or down. You do not try to time the bottom. You do not wait for the dip. You show up, you invest, you repeat. And you pair that with a basic valuation framework so you understand whether you are buying assets at a reasonable price or catching a falling knife with your bare hands. Next one. This coin is going to 100x. Get in now before it is too late. You have seen these videos. Some guy in a rented Lambo, or a screen recording of a chart going vertical, or the classic I turned $500 into $50,000 screenshot with zero context. Here's the context they leave out. As of 2026, over 47,000 cryptocurrencies have been declared dead, gone to zero, ceased to exist. The 99 Bitcoins dead coins dadbait dat fernicants. For every Bitcoin success story, there are literally thousands of projects that vaporize people's money. And look, I am not anti-crypto. I need to be honest with you here because I have personal experience with this exact trap. When I was 16 years old, I bought Neo. I made over 4,000%. 4,000%. I thought I was a genius. I thought I had cracked the code. So what did I do? I got cocky. I started gambling. I started chasing the next moonshot and the next one and the next one and the next one. And I did not just give back those gains. I lost everything plus more. I went negative. At 16. That is what no one on FinTalk shows you. They show the screenshot of the win. They never show the 20 losses that came before and after it. Here is the WB version. If you want crypto exposure, fine. Allocate 2 to 5% of your total portfolio. Money you can genuinely afford to lose entirely. Not your rent, not your emergency fund, not money you borrowed. Strategic allocation, not speculative gambling. There is a difference, and that difference is whether you are still standing in 5 years. This next one drives me crazy because it preys on people who are tired, people who are working hard and just want a break. Passive income with no money down. Okay, let's do real math for a second. A rental property. The average home price in the US. right now is around $300,000. A conventional mortgage requires 20 to 25% down. That is $60,000 to $75,000 in cash before you even get the keys. Then you have closing costs, repairs, vacancies, property management, insurance, taxes. No money down is a fantasy sold by people who make their actual money selling you a course about no money down. Dividends. Let's say you have $100,000 invested in a solid dividend portfolio yielding 3%, which is realistic. That gives you $3,000 a year. That is $250 a month. Now, $250 a month is real money. I am not dismissing it, but it is not quit your job money, and it required $100,000 of capital to generate. Nothing is passive without capital first. That is the dirty secret nobody on FinTalk wants to tell you, because save money for 10 years before you see meaningful passive income does not get views. Here is what actually works. You build the capital first. That means your savings rate is the engine, not the rental property, not the dividend stock, your savings rate. You save aggressively, you invest that capital consistently, and over time, those income-generating assets start to compound. But step 1 is boring, and step 1 takes years, and that is why nobody makes a 60-second video about it. Alright, this one. This one actually makes me angry. 0 DTE options, 0 days to expiry. These are options contracts that expire the same day you buy them, and there's a whole corner of FinTalk that presents these like they are a legitimate strategy. I turned $200 into $5,000 with 0 DTEs. Yeah, and the casino has a guy who won $50,000 on a slot machine too. They put his photo on the wall. They do not put up photos of the thousands of people who lost. The data on this is brutal. Studies and broker data consistently show that 70% or more of 0 DTE option buyers lose money on a per-trade basis. An at-the-money 0 DTE option can lose 30% of its premium in a single lunch hour if the underlying stock does not move. These contracts are designed to decay. That is literally what they do. Time decay is not a bug, it is the product. And by the way, 0 DTE volume hit a record in 2025, accounting for over 62% of all S&P 500 options volume. 2.4 million contracts a day. That is not a strategy gaining traction. That is a casino expanding its floor. Now look, I trade options, real options. I have had Tesla leaps, MicroStrategy positions. These are thesis-driven trades with defined risk and specific time horizons. I know the max I can lose before I enter the trade. I have a reason beyond, it might go up today. That is fundamentally different from buying a same-day lottery ticket because someone on TikTok showed you their one winning trade out of 50. The WB version, options are a tool within a portfolio. They're used for hedging, for income generation, for expressing a thesis with defined risk. They are not a slot machine. If someone is showing you 0 DTE wins without showing you the losses, they are not educating you, they are recruiting you. Last bad take, and honestly this one is the sneakiest, because it is sort of true. The market always goes up. On a long enough timeline, yeah, historically, broadly for the US market that has been the case. But sort of true can be more dangerous than completely wrong, because it gives you false confidence without the full picture. Japan. We already talked about it. 34 years to recover. An entire generation of investors who bought and held and watched their portfolios go sideways for decades. The S&P 500, the American market, the one everyone points to. From March 2000 to March 2013, it went 4,739 days with 0 gains in real terms. 13 years. If you invested $100,000 on the eve of Y2K and needed that money in 2010, you had less purchasing power than when you started. Adjusted for inflation, you lost over 37% of your buying power by the end of 2009. Always goes up is true on a 50-year chart. It is useless on a 10-year chart if you need the money. It is a bumper sticker, not a strategy. The WB version, the market rewards patient, diversified investors over long time horizons. That is the accurate statement. But it also punishes people who confuse a slogan with a plan. You need to know your time horizon. You need to be diversified across asset classes, not just the S&P 500. And you need to understand that long-term means you genuinely do not need this money for 15 to 20 years, minimum. If you do need it sooner, your allocation should reflect that. Stocks, bonds, cash, all in the right proportions for when you actually need the money. Okay, so here's the part that should really bother you. All of this, the bad takes, the missing risk disclosures, the misleading screenshots, this is not a bug. This is the system working exactly as designed. Think about how the algorithm works. What gets pushed to your For You page? Content that gets engagement. What gets engagement? Confidence, urgency, big numbers, bold claims. Invest in low-cost index funds and be patient for 30 years. Gets what? Nothing? No likes, no shares, no comments. It is financially sound advice and it is algorithmically dead on arrival. But I turned $500 into $50K with this one trick, gets millions of views. The creator who is wrong the loudest gets the most reach. The platform rewards confidence over accuracy, simplicity over nuance, urgency over disclosure. Every single time. And here is the twist. An uneducated investor is a profitable customer. For courses, for affiliate links, for paid groups, for hype cycles. If you actually understood that boring index fund investing works, you would never buy anyone's $997 trading course. You would never click their affiliate link for a sketchy broker. You would never join their paid Discord. The incentive structure is clear. Keep you confused, keep you chasing, keep you coming back for the next hot take. This is not incompetence. These creators are not dumb. The ones at the top know exactly what they are doing. They have just decided that your financial education is less important than their ad revenue. Alright, so if 80% of what is out there is wrong, what is actually right? What actually works? And look, I know this is the part where you might check out because the answer is not exciting, but that is kind of the point. The formula that builds wealth is boring. It has always been boring. And boring is why it works, because nobody is selling it to you, which means nobody is profiting off your confusion. Here it is. 5 pieces. Number 1. Save aggressively. Your savings rate is the weapon. Not your stock picks, not your crypto bets. Your savings rate. The gap between what you earn and what you spend is the single most important variable in your financial life. Widen it. Protect it. Number 2. Invest consistently. Dollar cost average into diversified assets. Index funds. ETFs. Broad market exposure. You do it every paycheck, every month, regardless of what the market is doing. You are not trying to time anything. You are buying ownership in the global economy on a schedule. Number 3. Size your risk. Never bet the farm on any single position. No single stock, no single coin, no single trade should have the power to ruin you. If it does, your position is too big. Period. Number 4. Think in decades, not days. Your time horizon is your greatest advantage. Compound interest does not care about this week's market crash. It cares about the next 20 years of consistent contributions. Let time do the heavy lifting. Number 5. Find sources with real skin in the game. Not people who make money by telling you what to do with your money. People who make money by doing the same things they are telling you to do. There is a massive difference, and you should be asking every single financial creator, where is your portfolio? Show me your positions. Show me your returns. Show me your losses. If they cannot answer those questions, they are not a source. They are a salesperson. You have 2 choices. You can keep getting your financial education from 60-second videos made by people who have never managed real money. People who profit when you stay confused. People who show you the wins and hide the losses. Or you can go deeper, with sources that show their work, sources with real skin in the game, sources that tell you the boring truth even when it does not get likes. I made it to 1 million by 2025 doing the boring stuff that does not get likes on TikTok, not by following anyone's hot takes. I have the portfolio to prove it. Follow Wealthy Beaver on X, the handle is on screen. Build something real. I want to see you win.